Hello, everyone, and welcome to our latest episode of Meet the Investor. Joining us today, we have Andrew Lockhart, Managing Partner at Metrics Credit Partners, one of the largest lenders in Australia outside of the big banks. Thank you very much for joining us today, Andrew.
Thanks very much, Joey. Thanks for having me.
I was wondering if we could start by you telling us a little bit about yourself, your career, and then going into what was the idea behind setting up Metrics and what Metrics is largely involved in today.
I spent 26 years working for National Australia Bank, and the genesis to the establishment of Metrics really came out as a result of the global financial crisis. So myself and my two other business partners worked together at NAB at the time, and I guess we saw firsthand, the difficulty that Australian companies were having in terms of getting banks to provide financing during that period of time. It was a period of very heightened stress in financial markets. But what we thought would happen was that the governments and regulators would respond. So there had been some changes in regulation that had occurred just around the time of the global financial crisis. And we've seen that continue because what the regulators have wanted is for the banks to be unquestionably strong, which has meant that they've been required to hold more capital. And when a bank is required to hold more capital, it becomes difficult for them to be able to generate the required returns for shareholders. And as a result of that, their lending appetite kind of reduces in certain parts of the market. So my background was I spent 26 years working for the bank. I had worked across a number of corporate finance roles within the bank. And then we established Metrics in 2013 when we launched our first fund. And at the time, the bank was also a shareholder in the business. And so we started our first fund in June of 2013, really to provide investors with direct access to the kinds of loan assets that really sit on bank balance sheets.
The big word around what people might associate Metrics with is private credit, which is a hot topic out there in the press frequently. It's a growing industry and asset class. How does that connect to what you just described as effectively, loans that you might see on a bank balance sheet? What do you define as private credit, and how would you describe the evolution of the asset class?
Yeah. So as a lender, a loan is a private transaction between a lender and a company, and we see that as being private debt. Our skill set and our background, our team's background, has really come from working inside banks and providing debt financing to large corporate institutional clients, companies. And so the fact that it's private just simply means that it's not publicly traded over an exchange. And yeah, it is a bit interesting because people feel like they get transparency and information because they can buy and sell shares on the stock exchange. But the reality of it is, that transparency between a lender and a borrower is even greater. Unfortunately, we just can't share that information necessarily with others, because of the obligation to maintain confidentiality with the companies. But it's interesting when you talk about the press and the media coverage. I look at it and I sort of say, well, there's probably four key areas where the media has sort of been critiquing private debt as an asset class recently. One is really around the macro risks, and part of that comes from the fact that the sector's grown quickly, and there's references to significant number of insolvencies. But again, that's in the smaller end of the market. So small and medium-sized businesses have certainly faced difficult periods of time. Larger corporate institutional borrowers, less so. But the other areas of criticism, I think, really come down to poor or weak lending standards in some private credit managers' funds, poor or weak governance standards because of the lack of transparency around the asset classes. So, and I'm happy to talk about all of these, Joey, with you if you'd like, because I think they're important for people to understand the distinction between our business and perhaps a broader market. Because there are real benefits for investors from having a manager that is large scaled, can provide access to well-diversified portfolios. One of the things that we think is really important for investors in the asset class is that, it is an asset class that, the biggest risk an investor faces is the risk of loss in the event of a default. And so you want to make sure that you've got really well diversified exposures and you're limiting the exposure to any one individual counterparty.
Yeah, and look, I was certainly going to ask a little bit about that, largely because in the last month or two alone, ASIC, the regulator, has come out frequently and talked about how they want to spend more time looking at the asset class, private debt, private credit, which is the asset class you are involved in. What do you think specifically they might be looking at, and how do you mitigate a lot of? Why would you not be concerned, say, as Metric, as a firm, as to what ASIC might be looking at, and what do you do to mitigate a lot of the concerns they might have?
Yeah, it's a really interesting area. If you think about it, ASIC grants an AFSL to a manager to operate in this market. And so, first of all, there's a compliance and a regulatory requirement around the licensing to be able to hold an Australian financial services license. I think one of the areas that is important for an investor to look at is the independence of a trustee. So if you have a related party trustee as the trustee of your fund, there's no independent oversight of the activities of the manager. It's a related party. So importantly, with our funds, we have independent third-party trustees or responsible entities that oversee our activities, and they are responsible for ensuring our compliance with the investment mandate criteria. Obviously, ASIC oversees the activities of those trustees. EQT and Perpetual are two of the publicly listed groups that provide those trustee services. And I think one of the things that's important is, because the assets require some high degree of knowledge around the credit quality of the borrowers and the like, one of the things that the trustee does in our particular funds is they've outsourced a review process on a monthly basis to test the valuation, to test for any impairment or risk of loss, to an independent large tier one accounting firm that oversees that. And so we also have ASX obligations, because we operate two listed funds on the Australian Stock Exchange that require continuous disclosure. So I think at the end of it, good governance, transparency of information with investors is very important in terms of distinguishing firms, but also comes down to solid track record. Our team have been lending for decades, and over an 11-year period since we launched our very first fund, we've consistently performed for investors, delivering positive returns each month and managing credit risk, so our investors haven't had an adverse impact as a result of credit events impacting their returns. So I think overall, those sorts of things are very important. But one of the challenges in the asset class for ASIC, in terms of requiring greater disclosure and transparency, is the loans are confidential between a borrower and a lender. The banks, for instance, don't disclose all of the information in relation to their loans that they've made to their customers. And so importantly, that confidentiality needs to be preserved. But equally, loans are not the same. You can have a high investment grade credit exposure, and you could have a sub-investment grade borrower. Unless managers rate and assess credit risk in a uniform and consistent way, which they don't, people rate and assess the risks in their own proprietary way. But without, first of all, having a common rating platform, it's very difficult to be able to provide information. It's much easier in property markets, where you can talk about the loan to valuation ratio, or you can describe certain aspects of the loan. But when you're lending to larger corporates, it's more difficult to be able to give an apples with apples comparison as to the risk in the portfolio.
Yeah, and I do want to come back to that, but maybe before we go deeper into the technicalities of the lending, can you give an example of the type of borrower that you might lend to?
Yeah, sure. We lend to quite a number of different sectors. So, for instance, we're active in what we call project and infrastructure funding, which is predominantly large-scale government-backed PPPs and the like. So, for instance, we're involved in the Mornington Peninsula motorway financing. We were involved in the Sydney and Victorian desalination plants, the Victorian Cancer Centre, project and infrastructure assets. On the corporate side, we lend to a number of large ASX publicly listed companies, some in the top 100 of the ASX. We're a significant lender in real estate markets, so probably around about 60% of our portfolio as a whole is exposed to commercial real estate related lending. And that's primarily short-term development funding for residential and industrial purposes. So if you're in Sydney and you're driving around, if you see a sort of a large-scale 30-story residential apartment tower, hopefully Metrics might have been involved in the financing of that particular project. And the other area where we're involved is we provide what we call acquisition finance to private equity firms where they're buying businesses. And so again, there are a number of very large-scale private equity-owned businesses, but one that comes to mind as we're talking is Arnott's Biscuits, for instance, that was bought by KKR a number of years ago. We're involved in the financing of that particular company.
Pick any one of those deals. Could you bring it to life for us in the sense of, firstly, how you'd be approached, but also including in your response why they wouldn't have just sourced that financing from a bank? I mean, some of these projects seem fairly high profile. You'd have thought a bank would be all over it in terms of lending and presumably at better terms, or at least interest rates. Well, why would Metrics be involved, and how would that come about?
Yeah, so often the larger corporate transactions or a project and infrastructure facility might be provided by a group of lenders. So we might be working with the banks to provide financing as one of a number of lenders that come together to provide the financing. On a number of our property transactions, however, we're often the sole lender to that project. And so our business is all about building long-term relationships with people in the market. And so we believe that if we can build long-term relationships with companies, then the opportunity for us to be able to do business with them and originate good quality transactions will deliver a good outcome for our investors. And so we have this view that we want to provide a high level of service, we want to be responsive, and we want to make sure that we're offering terms and conditions that are appropriate for the market and that we've priced the risk appropriately to provide the financing. And so we have a large team, over 160 odd people in our business that are responsible to assist us around originating lending opportunities, so sourcing opportunities with companies, and that's a proactive action, not just sitting around and waiting for people to contact us. It's about building those relationships and networks and finding opportunities to lend. And then when we've got an opportunity, we obviously have to undertake detailed risk assessment and due diligence to assess the risk. And so, say it was a property transaction, you'd have a client that large scale private property developer might be owns a site. We might be asked to provide acquisition financing to help them finance the settlement of that property. And then through that period of time, we'd get an independent valuation on the site, and it might also result in a change of use. So they might be wanting to build a large apartment tower on the building, in which case we'll go through a whole range of additional due diligence steps, to firm up the project budget. And so you'll have to assess the value of the property on completion. You'll have an independent quantity surveyor's report to assess the construction costs. We'll assess the time period it's going to take to deliver the project, and then we'll negotiate and factor in appropriate contingencies for cost overruns, for time, for finance costs, and all of those sorts of things, so that you've got a pre-agreed project budget that you're releasing funds on as the project is nearing completion. And through that process, obviously, there might be some pre-sales of the apartments. So purchasers might go and buy an apartment off the plan. So there's a significant amount of legal due diligence that's undertaken to assess the pre-sale contracts, to assess the construction contract, negotiate all of the loan agreements and all of the securities to provide the financing. And so they're quite, they take some months often to sort of negotiate and complete those transactions. But we've got a highly experienced team within our business. We have a number of lawyers internally that work with our team to negotiate and structure those transactions to mitigate the risk for our investors. But then obviously we want to build that relationship and find opportunities to continue to finance that group in other projects that they might undertake.
Well, having spent some time in a bank, that sounds very much like the process that a bank would run itself. Is that fair? Or
That's correct. Yeah, that is correct. Yeah. I think the background of myself and my partners have all spent decades working in banks. We're very familiar with how you rate and assess and manage credit risk, and that training came over that 26-year period where I worked at the bank, and my partners similar kind of periods where they worked in banks. And so we've seen a lot of different transactions, large scale transactions that have been completed in the market, and we've had the benefit of working with experienced and professional people in over our careers, and that training and that risk management culture is very much evident in the way in which we assess risk.
And I'm not sure I caught there why, say, particularly when you're the only lender on a deal, why that borrower may not be sourcing that financing from a bank. I mean, a lot of pushback in the space is private credit is just full of deals that the banks don't want. How do you address that?
That's quite a myth. The reality of it is, the banks can be quite selective in terms of who they might lend to, and they can be quite, take some time. And so one of the things that we offer, I think, to our development clients is certainty of funding and speed of execution. And so that ability to move quickly can often, whilst the borrower might end up paying a higher margin, it might actually result in lower holding costs or over time, because they've been able to move the project ahead more quickly than they might with a bank. And so we certainly are not by any means the lender of last resort. We take a prudent approach to the way in which we lend money. We're really there to negotiate for and on behalf of our investors when we're entering into these transactions. So we are our investors' representative in that negotiation with that borrower. And so, certainly from our perspective, we're not rushing out to do transactions that others wouldn't do. We want good long-term relationships with clients where we can do repeat business. And, one of the things that I guess is of benefit to our business is that we've been around a long time over our careers. We've established good long relationships with a lot of people in the market. And it is a relationship and network-driven opportunity. People want to do business with people they know and trust. And I guess we've been able to develop that reputation in the market, and that provides our investors with opportunities to deploy capital to generate returns without taking crazy risks.
A longer frame up for my next question, so bear with me. The market globally for private credit 4 years ago was at about $1 trillion. It's now, depending on your source, somewhere between $2 and $3 trillion. In Australia, I believe the size of the industry is at about 200 billion, having grown at 23% per annum CAGR over the last 10 years or so. With that much more money entering the space all the time, more money to be lent out, I suppose, more money available for lending, I sort of see three potential things that could happen. And I'm interested in your comment in those three things and maybe any of the other developments in the space. The first one is there's so much money out there to be lent that rates that borrowers will borrow at will compress towards the sort of rates they get from banks, which will make it less attractive for investors. Potentially, the more money that's there to be supplied has to be met with demand, which might not be there. So borrowers might end up being riskier in terms of trying to allocate that capital. And thirdly, as is normal for any growing industry, regulation gets more involved, and we've spoken about regulation to the point that it might change the structure of the asset class to make it look very different to what it is today. So rates compressing, riskier loans, and increased regulation changing the outlook. What are your thoughts on those aspects as this continues to grow at those sort of rates?
All very interesting, actually, because I guess in an environment where economic activity is expected to slow as a result of rising interest rates, you may find that lenders become more competitive to deploy capital. And so you do see that from time to time where margins and returns can compress. But what you also find is that when business or economic conditions slow, lenders become more conservative. And so you tend to find that, sometimes you get margins that can widen, so you can actually get the reverse. So at the moment, I think we're in a position where, credit quality and the outlook in the economy is not too bad. It's slowing. And so you probably are seeing a little bit more competition amongst lenders, banks and non-bank lenders looking to deploy capital. But generally, margins, aren't compressing, in a way that would adversely impact an investor's returns, across our portfolio. You don't. I think the interesting thing is when I don't know where some of the numbers come from, in terms of the quoted $200 billion in private debt in the Australian market. We're the largest private credit provider, and we're around 20 billion in assets under management. So I'm not 100% sure how those numbers have been derived, but certainly it sort of it may include those non-bank lenders that are providing home loans or car loans and other things. So the definition of private credit to come to that number could be quite extensive. But in our market, which is the corporate and institutional end of the market, I don't see a whole lot of new capital coming into the market. A lot of investors see size, scale, diversification as real benefits in terms of allocations to our funds. I think that you'll find that with the banks continue to move out of the market. They're tending to continue to focus more on the consumer and small, medium-sized business lending. And so that corporate institutional end of the market is less profitable for the banks. And so there is less supply. So you do get a dislocation. And we see that pretty evidently in certain parts of the loan market. And as it relates to regulation, at the end of it, we already supply APRA with all of the loan data of our funds. ASIC oversees our operations. If there was to be any additional change, from my perspective, I would sort of say I don't really see that there's anything that's broken. I guess I'm not close enough to other market participants, but certainly in our funds, we believe we adhere to very high governance standards. We've got a strong track record of performance with our investors, and we've got multiple parties that are independent of metrics that oversee and review our operations on a daily, monthly, quarterly and half-yearly type basis. So, I think the quality of the team, the track record of the team, the transparency and governance processes under which an investment product operates is really important for an investor. Again, we're investing our investors' capital. We represent our investors' interests in those negotiations. We're wholly answerable to our investors in terms of the performance of our funds. And so if there was a situation where, as a result of competition or increased supply and less demand or increasing regulatory pressure, I don't think it will adversely impact our investment products. But if it was, then investors will be free to choose. I think, when interest rates were at 10 basis points, we saw a significant amount of money flowing into our funds because on a comparative basis, the performance and the returns generated in private debt were more attractive than other alternative asset classes. And so one of the things I think about private credit and private debt in an investor's portfolio, it really can play multiple roles. At one end of the spectrum, it can be a very defensive, protective asset class. At the other end of the spectrum, it can be an asset class that is almost like a replacement for equity in an investor's portfolio. So the return and risk profile is not consistent across all lending activity. You can have a loan to one borrower that may present a higher risk and therefore it will be priced higher than a loan to a lower risk or a safer borrower. And so again, the mix of all of those assets then play pretty unique roles in investor portfolios.
Great. Andrew, I think we'll wrap it up there. Thank you so much for really fantastic insight on a topic that many investors would have heard a lot about, but maybe not with the level of insight you've just shown. So thank you very much.
Thank you very much, Joey.